What if I told you that the key to building lasting wealth in your business isn't about working harder, but thinking differently? Imagine shifting away from being an operator who drives every decision to becoming the investor who leverages smart strategies to grow your wealth. In today's video, I'm going to reveal how you can start that shift by focusing on one of the biggest game changers in wealth building: optimizing your taxes through a family office model. Stay with me because mastering this could completely transform your financial future. Before we can dive into optimizing your taxes, we need to first understand that there are four different types of business owners. There's the owner-operator with employees, the owner-leader, and finally, the owner-investor. These four distinct categories, which I call the business owner quadrant, represent not just how business owners handle their business, but also how business owners handle their wealth, handle their taxes, handle their estate planning. It's how they handle everything. So, for example, an owner-operator is someone that wears every single hat. They're an individual that does everything in their business. But I've also found that owner-operators also do everything in their wealth. So they try to, I'm the investor. I don't need help. I don't need investment advisors. I'm going to do it on my own. Buy my own real estate. I'm going to use Robinhood. I'm going to use those types of apps to do it on my own. Owner-operator with employees start to delegate some tasks, but they're still heavily driven in daily operations, but also the daily operations of the way taxes are handled, the way that they invest. There's very little difference between an owner-operator and an owner-operator with employees, except they choose to start delegating some tasks to other people. Owner leaders deliberately choose to remove themselves from daily operation, and they are more focused on strategy, but I have found that they still lack things that are necessary to make their business valuable, to be more strategic around taxes. Oftentimes, they're more aware of tax strategy, but they still miss out on a lot of things. And oftentimes has a probability of success that if you were choosing to which one of these has the highest probability, the probability of success when it comes to creating generational wealth for an owner leader still is not high enough to make you go, I'm going to make that the choice of how I'm going to behave. So if we're going to have the highest probability of success in our business and have it be sold and have a high valuation, we also have to embrace the owner investor mindset for the way that we handle our taxes, our wealth, and the way that we protect ourselves is the optimal way that you can start to shift away from low probability of success and start to shift into a new way with a high probability of success and a high probability of getting the outcomes that you're looking for, which in our case is generational income transformed into generational wealth, which gives you the permission to create generational impact. Now, there's lots of different ways that owner investors behave, but the one that we're going to focus on today is that they embrace this truth. The family office is the gold standard for advising. Many think that the family office is the gold standard for advising because they believe the family office advisors are world class. While there might be some in that category, I actually believe family offices are so successful, not because of the advisors, but because of the environment that the family office creates. Family offices create an environment that gets all levels and verticals of the financial industry sitting and talking in the same room. So you have accounting, wealth management, protection, business, insurance, all in the same room, all talking together. It's that environment that makes family offices so powerful. And I've come up with a mantra, the 3 C's. Family offices are so powerful because they communicate, collaborate consistently. That's the environment that you, as a successful business owner that might not have the ability to hire a family office yet, can copy today. communicate, collaborate consistently. So here's how you do that. Here's how you can create that environment inside of your advising environment right now. Here's how to do it. So first, you need to view yourself as the CEO of your wealth, your money, your impact. If you don't view yourself as that, if you delegate that to your financial advisor or accountant or attorney, you are not going to be able to replicate the family office. You need to take responsibility. You need to take the fiduciary responsibility on yourself to lead your family and your wealth to new heights. CEOs create vision. CEOs create a destination. You need to create that vision and destination for your family. And I challenge you to not make that destination age 65, but I challenge you to make that destination generations to come. Because when you have a generational vision, things change. Heights get bigger, wealth gets bigger, impact gets bigger. So I'd make that challenge. The second thing you're going to need is you're going to need a quarterback. Another word for this is you're going to need a COO, someone that's helping you collaborate and get all of these parties talking, because it's very likely that all of these parties probably don't want to talk. They already have lots on their plate. They want to be the best for you, but they don't want to communicate with other professionals. The quarterback is going to help make that happen. They're going to organize meetings and get people talking. There are 4 main departments or team members you need to have on your team that are communicating consistently. Number 1, tax. Number 2, wealth management. Number 3, protection. And finally, your business. You create wealth outside of your business with wealth management. You create wealth inside your business with your business asset. Then you have the protection piece that goes around them all. You use the tax piece to help make everything else more efficient. These 4 departments need to be meeting quarterly with you. Let me give an example. The CEO, the president, the owner of Now CFO does this with his team. He's created this family office environment for himself. He will force all of these members of his team to come in, sit down in the same room, and talk 4 times a year, discussing moves and their tax implications. Should we be considering the long-term vision? It's a conversation amongst all of them. And when you get those 4 groups conversing, magic happens. Now, you don't need to bring them all in and sit them down in the same room. Technology enables you to do this via Zoom, via phone calls. But you need to have them talking, communicating, collaborating consistently. And I'd recommend 3 to 4 times a year. We are going to dive deep into the tax team. But before we dive deep in the tax team, we need to understand a few things about the tax world. Number 1, 95% of the United States population doesn't need tax strategy. They don't need tax advice. So if 95% of the population fits that, how many accountants do you think actually provide great tax advice and can help you get through the tax world? Because you're not 95% of the population. You're a high income earning business owner with lots of income, lots of assets, and a lot on the table. If 95% of the population isn't like you, do you think that most accountants are going to be able to service you? The answer is pretty obvious. But how do you know whether you have an accountant that's serving the 95% or the 5%? Let's break that down right now. On the left-hand column, we have what I call the middle-class accountant, the 95% accountants. It looks like this. And if you start to resonate with this, that means that you're on the side that's not helping you maximize your tax situation, and you need to make a change. So number 1, it's going to be one accountant. That person is going to be extremely reactive. If that person offers any tax strategy or advice, it's going to come in one of 2 ways. Number 1, they're going to ask you to go buy stuff. Is there equipment that you can purchase? Is there a truck that you can buy? Is there a program you can buy? They want to help you buy stuff that you may or may not need. The second way that they offer advice is through qualified plans. So they're going to heavily emphasize the qualified plan. In fact, it's their crown jewel. That's the way they tax strategy. That's the only strategy they have because that works for the 95. They will tell you, I'm saving you a whole bunch of taxes by loading up those plans. The problem is that though qualified plans can have a place, they don't save you taxes. If you're planning right, you should have more money in the future, not less. And if you have more money in the future, that means your tax bill is either higher than it is today, or you're in a higher bracket, or you're paying exactly what you were going to pay anyway. So you haven't saved taxes by making the crown jewel the qualified plan. Most accountants in this category don't focus on creating passive income. All of your income is active, which is taxed at the highest brackets. And then all of your insurance is commercial. That is the 95% accountant. If that resonated with you, if that is your accounting situation, you have an accountant that is not servicing your needs to the level that needs to be serviced, and you're paying too much in taxes. It has nothing to do with being aggressive or trying to skirt the laws or hide income. It just means that they can't service you well. They can service 95% great, and they're great at that. But don't expect them to service you well. So the first shift you need to embrace is to move from one accountant to a family office style tax team. So it's no longer just one person that helps you plan. There's still one person that's your compliance officer that files your taxes, that gets things done, but you have a robust team around you. You need to move from one person to a family office tax team that communicates, collaborates consistently. Second, once you have the team, you need to have them proactively working with you. It's not waiting to the end of the year and then telling you how much they owe. It's we start in first quarter, meet again in second quarter, start taking action in the third quarter, and tie the bow on the fourth quarter. You should proactively be planning with your teams throughout the year. If you can embrace those two things, your tax situation will change forever. Get a tax team and get them proactively planning with you. The proactive planning will create, instead of you buying stuff, you're going to buy assets. There are assets that you can purchase that will save you taxes. Many people know that if you buy real estate, you can depreciate it, which allows you to offset the passive income from the real estate. Very tax efficient income. That's an asset that you can buy that saves you taxes. Other things like anything in the energy sector oftentimes saves you taxes. Agriculture oftentimes saves you taxes. That's buying assets that saves you taxes, but you won't have them unless you have the team, and you won't be able to access them unless you do it proactively. It shifts from making the qualified plan the crown jewel with the 95%. Now the qualified plan is just optional. Do we want to add some? Are we going to use it to maybe offset or defer some taxes to a later date? But it's not the crown jewel. You're shifting from making all of your income being active to more of it being passive. And lastly, you're shifting some of your insurance from all commercial to some starting to be private. That's the difference between them. You want to shift to the right as a successful business owner because that's how you permanently and consistently save taxes. How do you create the family office tax team? Let's look into it. This is what it should look like. You have the tax department, which is led by either the accountant or the tax strategist, or both. The accountant and tax strategist are going to meet with the other teams, the wealth management, the protection, and the business asset 3 to 4 times a year. Everyone else doesn't really meet with you or anyone else. The accountant and tax strategists have all of this under their belt. Now, there is going to be some of you that say, well, my accountant calls himself a tax strategist. You need to assume that your accountant can't be a tax strategist. It's so rare for your accountant to be able to be an accountant, a compliance officer, a filer of your taxes, and a tax strategist. Am I saying it's impossible? No. But I am inviting you to start thinking a little differently around it. Why don't I just have 2 people? I have an accountant who helps keep me compliant. I have a tax strategist who brings everything to the table. They collaborate and they come up with ideas for me that keep me legally and ethically having the lowest tax bill possible. That's the game. You probably have someone that isn't going to be able to do that for you. Now, if they have all of these members or some sort of members, maybe the accountant can be, but I would like you to start assuming that they can't and until proven wrong. So make them prove you wrong. And the way they prove you wrong is by having this family office level of team. So here's who should be on your tax team. Ready? Registered investment advisor. That is someone that is going to bring you those assets that can be purchased that will also save you taxes. If you don't have that member of your team, you can't buy those assets, which means you're not going to ever do them. Have to be a key member of the team. They will also help you do due diligence on those, and they will bring the investments to you. You don't have to go find them on your own. You're going to need tax attorneys. Tax attorneys can help with entity structuring, very specialized in specific tax strategies, but they're a member of the team. Don't get fooled into thinking a tax attorney can just take over everything, because they often talk a bigger game. But if you can get them doing one thing really well, great team member. Not everyone qualifies for the R&D credit, but the R&D credit, you need someone that can do that for you. A lot of accountants don't have the time, expertise, or dedication to do it. So have a specialist do it for you. If you get into real estate, cost segregation is something you should have. You should have a tax smart insurance advisor to help shift some of your commercial insurance into private insurance. You should have someone with tax smart benefit offerings where you save taxes by offering benefits to your employees and to your team. You should have someone, if your personal income, after all business expenses, reaches the 7-figure mark, you need to start having the conversation on, should we be looking at private placement life insurance? That person should be on your team. If they're not, you're never going to have the conversation. You're going to pay too much in taxes. This is the family office tax team. This is the team that will help you be proactive, that'll help you save taxes consistently forever. If you don't have this, I can almost guarantee that you're paying too much in taxes. Because asking an accountant to be the master of all of these people's expertise is asking someone to be more than they are. You're expecting too much of them. Instead of expecting too much of someone and getting mad on why am I paying so much in taxes, create it with them. And if your accountant isn't willing to create it with you, find someone that is. Stop doing what the 95% are doing and start doing what the 5% are doing, which is being really deliberate around the way they pay taxes. That exponentially gets worse. So if I pay 100 grand over in taxes, which is pretty consistent for a lot of the business owners we work with, 100 grand more in taxes this year, 110,000 next year because of inflation and we grew a little bit, 120, it starts to get really bad. Over a decade, you're going to pay $1 million more than you should have in taxes. That's $1 million that should have been in your portfolio, whether inside of your business or into the wealth outside of your business. That's $1 million that has been taken away from your family's ability to leave a generational impact. Because every dollar that stays with your family, every dollar that goes into your wealth journey has the ability to impact someone for generations. But if you choose to let it go away unnecessarily, and in this case to the IRS, you're choosing to have a less future than you could have had. I challenge you to start thinking differently, to start thinking like the 5%, to start thinking how family offices operate and why they are so successful. Communicate, collaborate consistently. It's the team approach that makes them different. Start thinking like an owner investor instead of an owner leader or an owner operator. Start thinking differently, and your wealth will begin to transform from just generational money into generational impact. I'm Justin Maxwell. Until next time, thank you.